Maintaining maximum refining capacity across the entire global network requires a constant, uninterrupted flow of raw crude every single day. Efficient management of that flow results in significant capital. In the fourth quarter, Bharat Petroleum reported a consolidated profit after tax of 5,625 crore rupees, with an earnings per share of 7.47. This daily stock chart shows BPCL in a period of price consolidation, oscillating within a highlighted yellow channel. The stock faces selling pressure at the 320.40 resistance level, while an ascending support trend line pushes higher lows toward that exact ceiling. This technical wedge reflects a direct conflict between two underlying forces: high-speed downstream operational agility and massive write-downs on international upstream assets. The macro environment this past year challenged global logistics. Ongoing tension in West Asia created significant disruptions for shipping lanes, particularly through the Strait of Hormuz. For BPCL, Middle Eastern term contracts yielded only 45 to 46% of their total requirements, creating a 10% operational shortfall. In global oil markets, refineries secure crude in two ways: term contracts, which guarantee a set volume over a period of time, and the spot market, where individual shipments are purchased at floating prices. To address the shortfall, management shifted away from their initial 55% term reliance, increasing spot market exposure to nearly 60% of total volume. Much of this spot volume was Russian crude, increasing from 25% in the third quarter to 31% by year-end. BPCL also diversified into other geographical grades to fill the gaps, including Venezuelan blends and West Texas Intermediate. This restructuring of the sourcing geography covered the supply deficit and secured the raw material pipeline through July 2026. Different crudes have distinct chemical assays. Grades from the US and Venezuela must be carefully blended to maintain output yields and protect distillation columns. Despite that complexity, BPCL achieved its highest ever annual refinery throughput of 41.15 million metric tons. The refineries operated at 116% of their nameplate capacity, which allows the company to spread fixed costs across a higher volume of finished products. This chart illustrates the financial result of that operational strategy. By optimizing spot crude and maximizing capacity, BPCL captured a gross refining margin of $11.74 per barrel. These cash flows have strengthened the balance sheet, resulting in a standalone debt-to-equity ratio of 0.11. This cash generation is the force behind the blue ascending trend line on the stock chart. High refinery utilization and low debt create a fundamental floor, preventing the stock from breaking downward during periods of market uncertainty. Upstream exploration and production are managed through BPCL's subsidiary, Bharat Petro Resources Limited, or BPRL. A major asset in the portfolio is the Mozambique LNG block, which contains a massive 70 trillion cubic feet reserve. Management reports that force majeure is resolved. There are now 6,000 workers on site, and construction of the facility is 42% complete. This phase of the project is project financed, requiring no further equity commitment from the parent company. With the first LNG expected by mid-2028 and no current capital drain, Mozambique represents a stable, long-term upstream asset. However, shifting our focus to the international waters of South America, the outlook is quite different for the BPCL 11 block in Brazil. The project was stalled by a 3-year delay in finalizing the tender for the FPSO vessel, which is required for offshore production and storage. As a result, the expectation for first oil and gas production has been pushed out to the 2031-2032 fiscal year. This chart shows the time value of money. When cash flows are delayed by years, their present value is reduced when discounted back to current numbers. This extended delay forced BPCL to take a 4,300 crore rupee impairment write-down on the Brazil asset's carrying value during the fourth quarter. This capital destruction correlates with the resistance ceiling on the stock chart. The market currently uses the 320 level as a ceiling, weighing the company's refining profitability against the multi-year uncertainty of its Brazilian investment. Future price action will depend on how the company deploys its capital. The capex budget for the next fiscal year is set at 25,000 crore rupees. The two largest allocations include 11,000 crore rupees for refining and petrochemicals and 10,000 crores for marketing and infrastructure. Much of the refining budget is directed at the Bina refinery expansion, which is currently at 23% progress. However, management has cautioned that Middle East conflicts are impacting the pricing and delivery of equipment for these projects. While the cash for these projects is secured, investors are pricing in the risk that external geopolitical factors could delay construction and impact future returns. The current daily chart summarizes the net effect of these operational results. High refinery utilization, the $11.74 margin, and a low debt profile continue to push against the stock's floor. The 4,300 crore Brazil impairment and mounting execution risks for new projects act as the primary resistance. A sustained breakout would likely require BPCL to maintain its 31% Russian crude pipeline through 2026 to protect current refining profitability. If management can defend their sourcing strategy and successfully award the Brazil FPSO tender, the fundamental metrics favor breaking the 320 resistance level.